Hi, I'm Todd Rosenbluth, Head of Research at VettaFi, and thanks for joining us for our latest episode of ETF360. I'm joined today by Johan Grahn of Allianz, and we're here to talk about defined outcome or buffer ETFs. Thanks for joining me, Johan.
Yeah, it's good to see you again, Todd. Nice to be here.
My pleasure. So let's start with the basics. What are buffered ETFs and how do they work?
Yeah, very simply put, they're ETFs that will give the investor access to S&P 500 returns. In this particular case, it's on the SPY ETF up to a certain cap, and then in return for capping the upside, you have a buffer on the downside. And in the case of our ETFs, that buffer is either 10% or 20%, and it lasts over a 12-month outcome period.
So we're hearing more from advisors of interest in this, but how are you seeing advisors using buffered ETFs?
Well, it's the versatility of the product is really what brings the interest to the advisors, because there's really only four different performance outcomes that you can expect from these ETFs. So if the market is down by less than the buffer itself, in the case of the 20% buffer, if the market is down by 20% or less, the investor is flat over that 12-month outcome period. And if the market is up by less than the cap, then you get to keep all of those returns. So on the downside, the market needs to go down by more than 20. Let's say the market is down 21%. That's when you lose 1%. If the market is down 22, you lose 2. And then on the upside, if the cap is, let's say, 12 or 13%, if the market rallies, it's up by 20, let's say, you still only get that 13. That's kind of the trade-off. And it makes it a very versatile type of product. In the case of a very simple example, if you invest $1 million on day one, we just launched our May products, for example, MAYT with a 10% buffer, and the other ticker is MAYW with a 20% buffer. If you invest in the 20% buffer on May 1, you get a cap that's almost 13%. You can make almost 13% over the next 12 months, in other words. And if you put the $1 million in on day one and the market is down, let's say we have this proverbial recession coming in and the market's tank, as long as they tank by less than 20%, you get to keep the $1 million less expenses. And then on the upside again, if things play out nicer than we perhaps are expecting, then you can make up to 13% if the markets go up. So basically you have, I know we're asking about how these are being used, but kind of how they're being thought of is you can use this to de-risk equity portfolios or equity sleeves if you want to be a little bit more conservative with your assets. We also see a lot of advisors use these ETFs, in particular the 20% buffer, to re-risk some of their less risky assets in the portfolio. That could be fixed income, for example. We also see advisors using them in place or inside of their alternative sleeves. It's a way to simplify the outcome that you're expecting from your alternatives. They give a really good diversification benefit to your portfolio. And then the fourth case that we typically see is that it's a way to get clients to come back to the markets. We still see a lot of cash on the sidelines, as I know you've covered many times. It's a way to tease that back into the equity market without jumping all the way in.
So we've got MAYT and MAYW. Those are two of the, I think, 18 ETFs that Allianz offers. Am I right?
Yeah, that's right. So we just launched those on May 1st, and we have more ETFs coming. So when we're done with the launch of our 10 and 20 suite, we'll have one ETF with a 12-month outcome period starting on the first day of each month of the year. And we also have two 6-month products that have shorter time periods. And a lot of investors like those funds because it gives you an opportunity to get that outcome period to reset every 6 months. So in other words, if the market is up, let's say for the sake of argument, you have a cap of 10%, making that up for a hypothetical example. The market goes up, and after it's up 10%, let's say you invested $1 million, now you have $1.1 million, so you made $100,000 over 6 months, and now you get that buffer to reset at the $1.1 million level, and now you have a new fresh upside potential in that 6-month product. So when it's all said and done, we'll have 12 10% buffers that are, and we have for each month, we have 12 20% buffers, and we still have the two 6-month products that effectively give you a new reset every 3 months.
So a great lineup. Where should folks learn more information besides on our ETF Trends website?
Yeah, no, thanks for that. It's a relatively new space, so a lot of advisors are still learning about this, and it's frankly there's a huge need for education around this. I mentioned we have a lot of different ETFs that we've launched, but the key here is that the simplicity of the structure. Once you get a hang of that, it's really easy to make decisions in terms of which one of these funds you want to buy or invest in or sell for that matter. We have a lot of tactical trading in the lineup as well, and these products are perfect for it because they're fully liquid. Now, if you want to learn more about these ETFs, or if you want to figure out which one might work for you, we have a lot of information on our website. It's AllianzIM.com. If it's easier for you to spell out bufferedetf.com, you can go to that website as well. It brings you to the same place. We have a lot of educational materials, and you also have historical data on how our funds performed. And you can also sort and by different outcome periods, caps, buffers, and so on and so forth to make it easy for you.
Thanks, Johan. Appreciate your insights. And thanks, everybody, for joining us for ETF 360. We'll see you next time.